Yo guys, welcome to the new video. In this video, I will exactly explain why the price moves and what is the mechanics between these moves. So you should ask yourself why the price is always moving like this, like this, like this, like this, not in a straightly manner, like this, not in a straightly manner. Because everybody will tell it's because the supply and demand. Because if the sellers are more, the price will drop, and if the buyers are more, the price will go up. It's complete bullshit. It's not true. The price moves from the algorithm. The algorithm delivers the price like this. If you see on the 5 seconds chart or 1 minute chart, every time frame the price always moves like this. Higher highs, higher lows, higher highs, higher lows. So it's because the algorithm is delivering the price. Even if you see in the 5 seconds time frame also, you will find these patterns. So do you think the sellers are selling the market using the 5 seconds time frame? It's nothing. It's because it's just the how the algorithm is designed. This is the structure of the algorithm, how it delivers the price like this through the fractal nature of the market. So by understanding this is the basic concept of the delivery of the price. So the algorithm will deliver the price like this. It will create the equal highs and it will do like this, or it can use the equal highs and take it as liquidity and do this. Anything can happen by the algorithm. So it is very hard to predict the algorithm that was coded by the IPDA means interbank algorithm. So that's the main important thing entity in the forex market to deliver the price. Because if you think the retail traders placing total $100 of buys here, let's say, this movement is not responsible by any retail traders or small banks. It is completely because of the smart money. Smart money means the very big institutions like BlackRock, etc., who have complete access to this market liquidity, and they have the algorithms and it will decide. The main role of the algorithm is to take the liquidity and fill the imbalances, because daily 6 trillion transactions takes place in the forex market. So that's why your $100 million complete retailer $100 million buy positions is nothing. You can't move a market, forex market, by an inch with your positions. It's all algorithmic. You can't beat the algorithm. If you have more than like $1 trillion like that, you can move the market. Otherwise, you can't make a single change in the market. So you can exactly tell that it's algorithmic. So to what levels this algorithm moves the price? This is the main question. This algorithm moves the price to the fundamental levels. Means if the country's economy and GDP is very good, so the money will automatically flow into the higher levels. So that's why the algorithm will deliver the price into the higher levels using the structural format. It can't move the market like this because there will be no liquidity. So they should induce the liquidity, take the retail. It is completely matrix. You are completely given false information. It's not supply and demand how the market moves. It's completely because of the algorithm taking out the liquidity and then delivering the price. So you understood how the price moves, right? So I will show you some of the basic concepts how you can understand this algorithm and use it in your advantage and move it with the algorithm. Move with the algorithm like these type of entries after the liquidity taking the entries. So don't worry, I will explain exactly how the algorithm works. So when coming into the video, first thing first, you should know what's the role of the algorithm and how it traps the traders. So the algorithm will move like this. So if there are X amount of buyers here, smart money people, it will take out the liquidity. Why they take out the liquidity? Liquidity means they have stop orders. These are the stop orders. Liquidity orders are the stop orders. If this is the stop orders, what it means? If they are buying, their stop orders means the sell orders. Because if there are 100 million people buying here, those 100 million people stop losses will be here. So all the stop losses got executed. Now the market makers provided liquidity for the big banks and everything to enter, so the smart money enters here, because if they enter anywhere in the market there will be huge slippage problems. So that's why for that problems they will manipulate the traders. Now they entered here and then they will move the price. This is the scenario when the order flow is bullish. So if the order flow is bullish, what are these liquidities are called? What are these liquidities are called? These liquidities are called as the transactional liquidities. These are also liquidities. These liquidities are the main reason for the retracement. If there is no liquidity, there will be no retracement. If there is only liquidity, there will be retracement. So what is the aim of this liquidity? Many people have buy stops here, buy stops, and their stop losses will be around here. So what happens if the buy stops got executed? If the buy stops got executed, the market will automatically move up. This is the transactional liquidity. If the transactional liquidity is taken out, we can easily tell the market wanna move the higher prices. So the algorithm has lot of losing positions here because it took the liquidity, right? To make this fake move, they should sell like 1 billion sell orders. So their sell orders are in huge loss and their buy orders are in huge profit. So what they will do is they will come back and re-mitigate their losses, and then they move in the direction. So that's why the pullbacks always happen. So this is why always the market move like this, pullbacks, because to make this small move they should sell, the market makers should sell, and if the market move up their positions will be a lot of loss, the selling positions will be a lot of loss and the buying positions will be a lot of profits. So to mitigate the selling positions into the break even, they will come at least at the to the breaker level and they will close all the sell positions and they will deliver the price. This is the basic scenario that was happening every day in the marketplace. If you see anything, this is why the reason liquidity taken out, the price is reversing. The liquidity taken out, the price is reversing, and the transactional liquidities are for the retracement. If there is no transactional liquidity, there will be the market maker can't retrace because there is no money for the smart money to execute. So that's why after the retracements, this is where the big money enters and they will continuously deliver the price. Orders execute, they will enter here again. And there is also retail pattern deception, means they will make fake retail people patterns like trend line, fake trend line, etc. And they will induce and they will reverse. So the time is fractal. The time is very, very fractal in nature, because the if you see the nature of the price, it will do sometimes accumulation, it will do reversal, it will do continuation. So the price is fractal. There is no set direction for the price. It can do whatever it wants because of the liquidity. So the time is also fractal. So I will exactly explain how to combine the time and price here and understand the algorithm, how the algorithm is coded. So this is one of the scenario. First they will accumulate the orders and then they will manipulate the orders and then they will distribute the orders. And many people think, many ICT people and smart money people will think you can't make money by using the retail traders, retail strategies and the smart money strategies. It's completely bullshit, because I know many traders, many millionaire traders who trade retail patterns and they are still earning millions, because algorithm also do favor for these chart patterns, because the market moves in cycles. If there is no liquidity, liquidity means chart patterns, there will be no one buying here or selling here. So that's why the market maker always produce these chart patterns. So if the retail people is selling here and having stop loss here, they won't. And if they buy here, stop loss here, they won't. So if the retail people is using good risk management and with good psychology, they can earn a lot of money like us. Smart money people also can do, because at the end of the day, after the liquidity is taken out, the market moves in the order flow. First thing, after the liquidity is taken out, the market follows the real order flow. For example, here if you see, I annotated this day today, I took the trade here. This is the equal highs got induced, and if you see here, after the liquidity sweep, the real order flow will take place. If the smart money people sold here, they will want again the same thing, liquidity grab. This is today's liquidity grab, same speed and aggression, taking out the liquidity. And if you observe the order flow here, this is where the break of the structure happened. Order flow, order flow, you can take the sell. Same thing happens over and over and again in the marketplace. So, and also I wanna make sure one thing. So many people will trade one strategy, many people will trade one strategy and move into the another strategy. If you do that type of thing, you can't never be profitable. You never be profitable, I'm telling. If you use the liquidity strategy or retail strategy, you will take losses. There is no 100% holy grail in the trading. You should take the hits in order to take the wins. So many people will think like this. If they have a strategy, and in 1 month, let's say in the August, they got insane amount of returns using that strategy, and on the next month September they lost some of the money, like -1% or -2%. Now what they will do is they will change the complete strategy, and they will uh, follow the new rules and new things, etc. So what's happening is the market moves in cycles. I told you the time is fractal and everything is fractal. So what's happening is, I will tell you. If you see the 4-hour time frame, the 4 hour is looking like this, right? It is having pullback. So if you see the 15 minutes, same scenario. If you see, it turned into the bullish and then it went bearish. So if you see here, the time is always fractal. The structure in the 4 minutes is not the same in the structure in the 15 minutes. It can change. It will change to the time frame you are in. And if you see the weekly time frame, the weekly time frame, it's bullish. Weekly time frame is bullish. And if you see the 15-minute time frame, it's bearish. So this is how you can combine the time and price fractality. So how the price will move, they will accumulate the orders, they will manipulate, and then they will distribute. So the same price cycle happens in the weekly time frame. I am explaining why you take the losing months and losing weeks. This is why the reason. So let's say this is in the daily time frame or 4-hour time frame. If this cycle is happened, sweep happened, and everything is ready for the distribution, and if you are using a smart liquidity strategy, like we're waiting for the liquidity sweeps and entering, so in this leg what you will do is you will take the trades like this at the previous test liquidities or anything. So what it will happen is they will take lot of hits, lot of losses. So this is the main reason of taking the losing cycles in the trading. It's completely normal. You can't predict the algorithm by 100%, but this is the main reason why losing cycles occur. But if the higher time frame and everything is aligning, you will get back into the set, because the market moves in the cycles. You never know in the high time frame why the manipulations and the distributions occur, because mostly it happens because of the news and FOMC like that news. So in the shorter time frame, what you can do is you can align your probabilities and trade. That's it. Even the retail concepts work. I'm telling, right? Even the retail concepts work. For example, let's see here. The trend line people get won. They buy here. They won. Same thing. Everything is supported by the algorithm. The thing is, you should have a proper mindset to trade. That's it. The main thing for this video is there is no 100% strategy ever, and it will never be a 2. If there is 100% strategy, once thing, everybody will exploit it and everybody will make money. That does not happen in the market. The algorithm is designed to efficient price action. That's it. It will take liquidity and it will deliver the price. So this is the thing I want to explain in this video, the losing cycles and winning cycles. You can't know when the liquidity is induced and it will go up or reverse. It's just a game of the probabilities. But if you use the liquidity inducement theorem, the win rate will be very higher when compared to the retail concepts. You can make lot of money when compared to the retail concept. So this is the main thing I want to discuss about the video. So if you want to learn my liquidity inducement theorem and join my course, you can send me a WhatsApp DM. I will add you if I think you are a correct fit for my community. Peace guys, hope you enjoyed the video and learned how the price moves from one point to the one point and the fractality nature of the time and price.